Hello and welcome to this session. In today's session, you will learn about interest rate swaps. In this session, you will learn about interest rate swaps, uses of IRS, risk associated with IRS, the key term associated with IRS, timeline of an IRS, types of interest rate swaps, long versus short IRS, pricing and valuation of interest rate swaps, the effect of rating in swap market, and Libor, the benchmark rate used frequently in interest rate swaps. Let us begin with a brief introduction on fixed income derivatives. A fixed income derivative is a contract whose value is derived from a value of a fixed income security. For instance, a bond future is a derivative priced in accordance with the anticipated price of an underlying bond or bond index. There are two basic types of fixed income derivatives, both of which are OTC derivatives. First type, the interest rate derivatives, which are based on direction of interest rate. Interest rate derivatives is what you will learn about in this module. The second type, credit derivatives, are based on credit risk or the probability of bond issuer defaulting on an obligation. We will learn about credit derivatives in a subsequent module. Let us begin with one of the most popular types of swap, which is interest rate swaps. An interest rate swap or IRS is a financial derivative instrument in which two parties agree to exchange interest rate cash flows based on a specified notional amount from a fixed rate to a floating rate, or vice versa, or from one floating rate to another. Interest rate swaps can be used for both hedging and speculating. Interest rate swaps have become an integral part of the fixed income market. The interest rate swaps market started decades ago as a way for corporations to manage their debts and has since grown into one of the most useful and liquid derivative markets in the world. In an interest rate swap, each counterparty agrees to pay either a fixed or a floating rate denominated in a particular currency to the other counterparty. The fixed or floating rate is multiplied by a notional principal amount to arrive at the size of cash flow. When both legs are in the same currency, this notional amount is typically not exchanged between counterparties but is used only for calculating the size of cash flows to be exchanged. When the legs are in different currencies, the respective notional amounts are typically exchanged at the start and the end of the swap, which is called cross-currency interest rate swap. For example, Bank A agrees to pay Bank B a fixed interest rate payment of 5% in exchange for floating rate interest payments of Libor plus 50 basis points on a predetermined notional amount. Libor is short for London Interbank Offer Rate, which is a benchmark rate for all borrowing and lending amongst banks in London market. We will learn about Libor in much more detail in this very module. So investors typically use interest rate swap to capitalize on changes in interest rates and to manage fixed or floating assets and liabilities. Interest rate swaps become an essential tool for many types of investors as well as corporate treasurers, risk managers and banks because they have so many potential uses. First we have portfolio management. Interest rate swaps allow portfolio managers to add or subtract duration, adjust interest rate exposure, offset the risk posed by interest rate volatility. By increasing or decreasing interest rate exposure in various parts of the yield curve using swaps, managers can either ramp up or neutralize their exposure to changes in the shape of the curve and also express views on credit spreads. Swaps can also act as substitute for other less liquid fixed income instruments Moreover, long-dated interest rate swaps can increase the duration of a portfolio, making them an effective tool in liability-driven investing, where managers aim to match the duration of assets with that of a long-term liabilities. Second is speculation. Because swaps require little capital upfront, they give fixed income traders a way to speculate on movements in interest rate while potentially avoiding the cost of long and short position in treasuries. For example, to speculate that 5-year rates will fall using cash in treasury market, a trader must invest cash or borrowed capital to buy a 5-year treasury note. Instead, the trader could receive fixed in a 5-year swap transaction which offers a similar speculative bet on falling rate but does not require significant capital upfront. Then we have corporate financing. Firms with floating rate liabilities such as loan linked to Libor can enter into swaps where they pay fixed and receive floating as noted earlier. Companies might also set up swaps to pay floating and receive fixed as a hedge against falling interest rate or if floating rates more closely match their assets or income stream. Next we have risk management. Banks or other financial institutions are involved in a huge number of transactions involving loans, derivatives, contracts and other investments. The bulk of fixed and floating interest rate exposure typically cancel each other out, but any remaining interest rate risk can be offset with interest rate swaps. Finally, IRS are used for rate lock on bonds issuance. When corporations decide to issue fixed rate bonds, they usually lock in the current interest rate by entering into swap contract that gives them time to go out find investors for the bond. Once they actually sell the bonds, they exit the swap contract. If rates have gone up since the decision to sell bonds, the swap contracts will be worth more, offsetting the increased financing costs. Like most non-government fixed income investment, interest rate swaps also involve two primary risks: interest rate risk and credit risk, which is known in the swap markets as counterparty risk. Because actual interest rate movements do not always match expectation, swaps entail a high degree of interest rate risk. Put simply, a receiver, that is the counterparty receiving a fixed rate payment stream, profit if interest rates fall and loses if interest rates rise. Conversely, the payer, that is the counterparty paying fixed rate, profit if rates rise and loses if rates fall. Shown on the screen is a typical swap transaction at inception. However, the point to note is that the forward Libor curve changes constantly over time as interest rates implied by the curve change and as credit spreads fluctuate, the balance between the grey zone and blue zone will shift. If interest rates fall or stay lower than expected, the receiver of fixed will profit. That is, the grey area will expand relative to blue. If rates rise and hold higher than expected, the receiver will lose. That is, the blue area expands relative to the grey. If a swap becomes unprofitable or if a counterparty wishes to shed the interest rate risk of the swap, then counterparty can set up a countervailing swap, essentially a mirror image of the original swap, with a different counterparty to cancel out the impact of original swap. For example, a receiver could set up a countervailing swap in which he pays the fixed rate. IRS are also subject to the counterparty's credit risk, the chance that the other party in contract will default on its own responsibility. Although this risk is very low, banks that deal in Libor and interest rate swaps generally have very high credit rating of AA and above. It is still higher than that of a risk-free US Treasury bond. Next, let us look at some of the important terms associated with IRS. Let us first start with the trade date. It is the date on which trade is agreed between two parties. The effective date is the date from which the swap is effective. The reset frequency term indicate how often will the interest rates be recalculated. It could be monthly, quarterly, semi-annually, yearly, etc. The reset date is the date on which interest rates are recalculated or readjusted to the market rates. On the payment date, the funds are exchanged between two parties. The termination date is the last reset date of the swap. The term indicates the time period of a swap. It could be 2 years, 5 years, etc. The notional is the amount on which the cash flows are calculated. The credit events are events applicable to the IRS contract. Continuing further in IRS, we have the currency term is used to denote the currency of transaction. In the direction buy means paying the fixed rate and sell means paying in floating rate. The counterparty is opposite party in a transaction. The fixed rate term is used for fixed rate used in a swap. The floating rate term is used for floating rate of the swap. The spread term is used for the spread which is implemented on the floating rate. The day count convention is used to count the number of days between two reset dates in order to calculate the payments. The reference obligation notional amount is the notional amount of the IRS contract that is paid by protection seller to the buyer. Let us now look at how these terms are used. The example shown on the screen shows the interest rate swap trade economics captured in books of client A. The trade date and effective date are same, which means that the interest calculation will be done from 1st April 2015. The interest will be exchanged twice in a year since the frequency is semi-annually, which also means that the floating rate, which in this case is Libor, will be adjusted every 6 months. In this case, it will be on 1st October and 1st April until the termination date. The term is for 5 years, which is automatically makes the termination year as 2020, and the termination date is calculated from effective date. Here, the floating rate mentioned is 6 months. Libor rate and spread is 50 basis point is the spread. These details are important parameters which need to be agreed while negotiating an interest rate swaps agreement. The timeline shown on the screen gives a pictorial view of an interest rate swap based on the example shown earlier. The trade date is 1st April 2015, which is also the effective date. The reset is semi-annual, which means the interest will be exchanged twice a year. The first reset payment is done at the next reset date, which is 1st October 2015. The next reset is on 1st April 2016, which is when the payment for the previous 6 months will be made. This will continue till the termination date, which is April 2020. Moving on to the types of swap. As an OTC instrument, interest rate swaps can come in a number of varieties and can be structured to meet the specific needs of the counterparties. There are two types of interest rate swaps. First is the fixed for floating rate swap. It involves the exchange of fixed interest payment in exchange for another floating interest payment. In a fixed for floating rate swap, also known as plain vanilla interest rate swap, Company A and Company B choose a time frame, a principal amount, a single currency, a fixed interest rate, a floating interest rate, and payment dates. On the specified payment dates for the duration of time frame, Company A pays Company B a fixed rate of interest on the principal amount, and Company B pays Company A a floating interest rate on the principal amount. All payments are made in the same currency, and only the net sum of each payment exchanges hand. The purpose of such an exchange might be to reduce interest rate risk. Second type of IRS is floating for floating rate swap. This involves the exchange of a floating interest payment in exchange for another floating interest payment. In this type of swap, the two parties swap variable interest rates based on different money market. This is usually done to limit interest rate risk that a company faces as a result of having differing lending and borrowing rates. For example, Company A lends money to Company B at a variable rate that is tied to Libor, but they borrow money based on treasury bill rate. This difference between the borrowing and lending rates, the spread, leads to interest rate risk. By entering into basis rate swap, where they exchange the T-bill rate for Libor rate, they eliminate this interest rate risk. Let's take an example of a fixed for floating interest rate swap. In this example, client A and B are entering into interest rate swap for notional amount of 10 million euros. During IRS, the two parties of transaction will only exchange cash flows based on the interest rates. There is no exchange of the notional amount in an IRS. Here, client A agrees to pay a fixed rate of interest at 4%. Client B agrees to pay a floating rate of return at prevailing Libor rate. Let us assume the Libor rate is 5%. At the time of settlement, if the Libor rate is more than the fixed rate of 4%, the net balance will be paid by client B to client A and vice versa. Here we have another example of an interest rate swap in a floating for floating scenario. Client A and client B are entering into interest rate swap on a floating rate of interest on Libor and Euribor for the notional amount of 10 million euros. Client A agrees to pay Euribor and client B agrees to pay Libor on a periodic basis. Here both the interest rates are dependent on the floating rates. At the time of settlement, if the payment streams will be netted off and balance amounts will be paid by client A if Euribor is higher than the Libor and vice versa. There is a long position and short position for interest rate swaps. Fixed rate payer or the floating rate receiver is often referred to as having bought the swap or having a long position. The floating rate payer or the fixed rate receiver is referred to having sold the swap and being short. For the interest rate, paying fixed is equal to having a long position while paying float is equal to having short position. For foreign exchange, a long position means you will receive while a short position means you will have to pay. Plain vanilla interest rate swaps are fixed to variable interest rate swap. This means one party pays fixed and other floating rate of interest, and hence in a plain vanilla swap, two parties facing different types of interest rate risk can exchange interest payments. Straight or plain vanilla swaps are also known as generic swaps. Here, one party exchanges a fixed rate payment while the other party exchanges a floating rate payment. Variants from the straight vanilla swaps are called as non-generic or exotic swaps. Innovative banks or intermediaries have created a multiple variant on the basic fixed for floating plain vanilla interest rate swap in an effort to better serve potential counterparties. When the interest rate changes, the party that benefits from a swap receives a net cash payment while the party that loses makes a net cash payment. An interest rate swap of fixed for floating rate is equivalent to a sequence of long forward contracts of buying with different maturity dates, while the counterparty to swap pays a floating rate in return for a fixed rate and is effectively a sequence of short forward contracts or selling. Let us now learn about the mechanism of a plain vanilla interest rate swap as shown on screen. Here, Scholes Inc. and BT Bank enter into a swap involving a principal of $30 million for 5 years. An international bank with a AAA credit risk rating who needs to raise $30 million for 5 years. The bank prefers a floating rate loan. Available options to B2B are a fixed rate of 8.25% or a floating rate of Libor. Skoll Inc. prefers a fixed rate loan while BT Bank is interested in floating rate interest. A multinational corporation with a credit rating of BBB, Scholes Inc. also needs to raise $30 million for 5 years. it prefers a fixed rate loan. It can manage a loan on a floating rate of Libor plus 1% or a fixed rate of 10%. It is important to note that the table highlights the available borrowing options for both the banks based on credit rating. Skol's Bank has a credit rating of BBB against BTB, which has a credit rating of AAA, and hence Skol banks will be borrowing at a higher rate against BTB. We will now explain the cash flows associated with the transaction for Skol's Inc. Here's the assumption is that the reset date is 12 months from effective date. Assuming the Libor rate for the dollar for this illustration is 0.125% or 1.25 basis points, the payment of the interest accrued from floating cash flow will be $3,12,500 as per calculation shown and will be paid to BT Bank. The cash flows for BT Bank will be the reverse. Index differential swaps are basis swap where the two legs of the swap are on floating interest rate on two different currencies. They are also known as quanto swaps, quanto basis swaps. However, the underliers are not in the same currency. For example, 6 million USD Libor versus 6 million Euro Euribor. If you notice, two different floating rate of interest is used, Libor and Euribor, which are benchmark rates for borrowing and lending. So, how do index differential swaps work? The index differential swap structures entails the payments and receipts to be made in one currency, hence removes the currency conversion risk. All payments and receipts are calculated on floating rates if a counterparty receives payments in a specific currency on a notional principal amount for a specified term on the basis of a floating interest rate, then the counterparty makes payments on the same notional principal amount based on the floating interest rates in a different currency. The interest rates are generally the money market rates of the respective countries. There is no exchange of principal amounts. Let us move on to coupon swaps. Coupon swaps are interest rate swaps involving exchange of an interest stream based on and fixed interest rate for an interest stream based on floating interest rates such as Libor. In order to distinguish the counterparties to a coupon swap, one is termed the payer and the other as the receiver. These terms refer to the fixed interest stream in a coupon swap, which means the counterparty paying the fixed interest is payer, while the one receiving the fixed interest will be receiver. Next, we will talk about basic transaction of a coupon swap. The screen shows that the borrower with credit rating of AAA is looking to borrow at a floating rate of interest, whereas the borrower with a credit rating of BBB is looking to borrow at a fixed rate of interest. If you look at the table for the borrower with AAA rating and BBB rating, you can clearly see how swapping of interest rate can bring saving of 0.25% and 0.5% respectively. The funding cost of AAA rated bank is 12% and the floating rate of interest, that is Libor, is to be paid as part of the swap contract and fixed rate is 12.5% is received, which means overall cost is Libor plus 0.25%. Now if the funding cost is Libor effectively, the saving of bank A is 0.25% or 25 bps. In the same way, the bank with BBB rating saves 0.5% or 5 bps. In the whole process, the intermediary earns 0.25% of notional amount. It is evident that one of the other is very important reason for swap is a reduction in borrowing cost. IRS is a fixed income derivative and therefore gets a credit rating. Depending on their ratings, companies attract different risk premiums in the fixed rate capital market. This can be better explained with the help of an example. Consider two companies XYZ and ABC with the rating of AAA and BBB respectively. It is clear that company XYZ, due to its triple rating, has an advantage in both funding markets since the chances of repayment are high. In the fixed market, its advantage is 150 basis points, whilst the floating rate market, the advantage is just 25 basis points. To explain this, since bond XYZ has been rated AAA, it means it has been given the highest credit rating and hence the borrowing is cheaper with lower rate of interest, with XYZ bond being the underlier. The reason being the chances of them repaying the loan are very high. It has become a convention in swap market to use Libor, usually 6-month Libor, as the standard index for floating interest rate in coupon swap unless otherwise specified. The fixed interest rate in a coupon swap is called swap rate. The fixed rates in coupon swaps are quoted in absolute term, that is, as full percentage annual yield. This is also a practice in case of currencies which have less liquid swap markets and is referred to all-in price of the swap. Shown on the screen is example of all-in swap rate quote. So how is the fixed rate calculated in IRS? The present value of the swap helps an investor decide how much they will receive if they invest in any other financial product at compound interest. Therefore, at first, we calculate the present value of all the future interest rate payments expected to be paid during the lifetime of the swap. In order to calculate the present value, we divide the semi-annual rate by 100. Let denote this by R, which will be 2 divided by 100, which is 0.02. Now the formula of present value is equal to 1 divided by 1 plus R, which is equal to 1 divided by 1 plus 0.02, which is equal to 0.9804. This will be floating rate discount factor. The numbers corresponding to each date reflect the time value of money principal and reflect what $1 in the future is worth for today, each given day. Also, notice that present value is decreasing with time due to floating rate payment. Now, if the floating rate is increased, then floating rate payment will go up as well, as you can see on the screen. Let us take an example of interest rate swap. Suppose ABC Corporation has taken a floating rate loan at Libor plus 40 basis points from counterparty. ABC wants to avoid this floating rate interest, so it enters into a contract with the dealer. The dealer has quoted 4.97%, that is the ongoing treasury bill rate plus 68 basis point in exchange for Libor for a 4-year duration. So what will be the total cost of funding for ABC Corporation? For entering into the swap contract, ABC Corporation pays the dealer 4.97% plus 0.68, which is 5.65%. The total cost to ABC Corporation is equal to floating rate, which it pays to counterparty, plus the fixed rate that is paid to dealer minus the floating rate it receives from dealer. So you have Libor plus 40 bips plus 5.65% minus Libor, that is 0.4% plus 5.65%, which is 6.05%. So ABC Corporation has changed its interest rate from floating rate to our fixed rate of 6.05%. So how do you determine the present value of swap? It comprises of 2 steps. First step is pricing the swap, which refers to obtaining the current prices and interest rates that the market maker is willing to enter into a swap transaction. And next step is valuing the swap. This refers to applying the market prices to an outstanding swap to determine the amount of cash or present value that would be paid or received to terminate the swap. A swap generally can be replicated by cash market transactions. Moving on to Libor. Libor is in London Interbank Offer Rate, which is a benchmark rate for borrowing and lending amongst banks in London market. Libor is the rate at which panel of banks lend to each other for a specific period of time. Libor rates are published by ICE Benchmark Association, also known as IBA, which was formerly called as British Banking Association or BBA. So, how are Libor rates calculated? Libor rates are calculated across 5 different currencies, which include US dollar, the British pound, the euro, the Swiss franc, and the Japanese yen. At around 11 a.m., the banks inform Thomson Reuters the rate at which they are borrowing from the market, and the rates are kept confidential. Later, these rates are published between 5 p.m. to 6 p.m. daily. Libor have 7 different maturities, which are 1 day, 1 week, 1 month, 2 months, 3 months, 6 months, or 12 months. Each panel consists of at least 8 and a maximum of 16 banks. The rates are assessed on their market volume, reputation, and understanding of currencies involved. Once the rates are collected, the highest and lowest 25% of the rates are eliminated. The average of middle 50% is taken and published as the Libor rate. This rate is published on daily basis, which we also call as the floating rate of interest. There has been a lot of talk lately of high-profile cases of Libor rigging. What is it all about? Let's find out. The Libor rigging scandal arose when it was discovered that the banks are falsely inflating or deflating their rates so as to profit from traders or to make them appear more creditworthy than actually they were. Because Libor is used in US derivative market, any attempt to manipulate Libor is an attempt to manipulate the US derivative market and thus a violation of American law. Now, since mortgages, student loans, and other financial derivatives often rely on Libor, and any manipulation can have serious negative effect, in June 2012, multiple criminal settlements by Barclays Bank revealed significant fraud and collusion by member banks. The graph on the screen shows the total value of securities impacted by Libor is around $800 trillion. Some of the major banks associated with the Libor rigging case included Barclays Bank, UBS, Bank of America, JP Morgan, Citibank, Deutsche Bank, and HSBC. The screen shows a discussion between traders of two banks which has clearly been captured. It is very clearly shows how traders were manipulating rates in order to make undue profits on their trading positions. The issue came to light in year 2012 when one of the major British banks, Barclays, was caught and penalized under criminal law. The fines implemented were extremely high, with some of the major banks paying up to $3 billion in fines. This brings us to the end of this topic on interest rate swaps. That's it for now. Thank you.